Earlier, we clued you in on the risk covered by an AD&D policy just by the name of the contract: accidental death and dismemberment. Now you know the benefits that are payable, how they're paid, and the differences between principal and capital sum payments. Remember, the principal sum is paid for the accidental death and for multiple dismemberments that occur in the same accident. You also learned the death must occur within a specified period following the accident, typically 90 to 180 days, depending on the language used in the policy. While inexpensive compared to medical insurance, accidental death and dismemberment policies are still underwritten by insurers. If the proposed insurer doesn't have any high-risk occupations or hobbies, the policy will likely be issued. On the other hand, if the applicant is a thrill seeker, there is a distinct possibility the policy won't be issued, as potential for loss is much higher. We'll start our next section with a discussion on medical expense insurance and its variations. Some of these policies have been around for a long time and are still sold today, but due to changes in the industry, they're not nearly as popular as they once were. Basic medical, hospital, and surgical policies were the beginning of medical coverage, but they no longer provide coverage that's considered sufficient or adequate in today's world. We'll compare coverage in a comprehensive policy to a limited or specified coverage policy, and you'll see there are huge differences in protection. We'll look at issues related to major medical expense coverage. Traditionally, major medical has been at the forefront of comprehensive medical insurance. However, there are now many alternatives to traditional coverage, like HMOs and PPOs, which have completely different methods of covering individuals. Major medical policies routinely have provisions such as deductibles and coinsurance, which are cost-sharing mechanisms found in these policies. They also have ways that the policy will limit the annual out-of-pocket costs through the use of stop-loss and maximum out-of-pocket provisions. We'll discuss deductibles, coinsurance, cost-sharing measures, and other ways an insured might be able to limit how much money is spent on a medical claim. From there, we move on to Health Maintenance Organization, or HMOs. HMOs have been around a lot longer than most consumers know. In fact, their genesis was World War II and a gentleman named Henry Kaiser. Famed for his Liberty Ship shipyards during the war, Mr. Kaiser introduced Kaiser Healthcare to take care of his workers, one of the first HMOs conceived. The intent and purpose of HMOs are to prevent future medical problems, as they emphasize prevention through their significant use of physicals, screenings, vaccinations, and more. Next up are Preferred Provider Organizations, or PPOs. They're a hybrid between the freedom of choice of medical providers in a major medical plan and the somewhat restrictive nature of HMOs. PPOs were the last comprehensive medical plans conceived and have only been around since 1980. They give the participant a choice. They can stay in the PPO's network of providers and save money, or if the insured wants to seek medical treatment outside of the network, that's covered too, but on a lesser basis. Finally, we'll take a good look at what are called high-deductible health plans. The purpose of these plans is to lower premiums with a higher than typical deductible. In order to have a high-deductible health plan, it must be paired with a health savings account, or HSA.